Good morning, ladies and gentlemen, and a special welcome to all the shareholders on the line. We're here for the interim results presentation of PSG Group. I will go through the presentation, then there is an opportunity for questions afterwards. You can lodge your questions while I go through the presentation. Thank you. So on the agenda, I'll talk about the material transactions in the last 6 months, a bit more about PSG 3.0, then a discussion on our underlying investee companies, a lot more detail on PSG Alpha Investments, and we'll talk about the valuations of the larger companies within the group, and then obviously, a lot of the companies within the group are listed, and you can go and view their specific presentations because most of them have come up with their interim results recently if you need more information. So firstly, the Capitec unbundling, the theoretical share value unlock, and this is purely for illustrative purposes. So if you look at it, the current PSG sum of the parts is R82.80. We're trading at a discount of 43%. So the current share price is R47. If you add back the value of the unbundled Capitec shares which you received, the total value attributable to PSG would be R195 per share. If we hadn't unbundled the Capitec, then the sum of the parts value, as in the top table, would still be R82.80 for the other investments. You would have the Capitec unbundled shares of 148 would still be within PSG, giving a theoretical sum of the parts of R231. If you then assume the discount we were trading at for the past year, averaged at about 26%, then the theoretical PSG Group share price would have been 171. The lift up in value as a result of the unlock or the unbundling was R24 per share, or 14% lift up. Curro did a large rights offer of 1.5 billion. The rationale for that was firstly to reduce the debt. There was significant uncertainty in the market when we launched this. Schools were closed. We were struggling to get from level 5 to 4, and there was very little insight from government how this is going to play out. So we acted on the side of prudency to reduce the debt, but it's also given Curro firepower to take advantage of the situation and maybe make 1 or 2 large acquisitions. PSG underwrote 1.15 billion of the rights issue, and we eventually ended up investing 1.05 billion. During this period, we've increased our stake from about 55% to 60% at R8.7. Given the current trading level of Curro, it appears to be a good transaction for us. Then this is quite an important event. We changed the accounting principles at PSG. We believe as a management team and the auditors as well that it will make the accounting significantly more understandable at a PSG group level. Previously, just to remind everybody, we consolidated a diverse group of companies, and if you looked at the income statement and the balance sheet, it really didn't make sense. Now that we've been classified as an investment entity, we will essentially mark to market all the assets, and the balance sheet will very much represent the sum of the parts as we've always shown it, and it would be a lot more clearer to the investment community what the head office costs are that are attributable to the team here in Stellenbosch. So I would like to reiterate what our main objective has always been, and this has always been here since Jannie started the company in November 95, and was to create shareholder value on a per share basis. That is extremely important. We're not here to build an empire, but to deliver returns for shareholders on a per share basis. And there are essentially three ways one can do it. The first is to grow the underlying businesses. Historically, we've been fairly successful in that. Pay dividends over time, and then do value enhancing transactions. This includes sell or unbundle investments when opportune, but even in certain instances, buying back shares. But we sit with the economic reality. We're at the lost decade where state capture, corruption, malmanagement of SOEs, destruction of state organs, and spiraling government debt was the order of the day. Just as we thought President Ramaphosa was going to get us online, COVID-19 hit, and it's been a disaster not only for South Africa but for the world. In Q2, the GDP in South Africa had a retraction of 16.4%. About 3 million jobs were lost. The economy is struggling. South Africa was downgraded, and the remaining lockdown restrictions still affect many businesses. And I feel sorry for my friends operating in the tourism and hospitality industry because it's far from having fully recovered. This creates significant uncertainty. And obviously people ask us what are our actions and what's going to happen. We still don't really know. We've seen the effects of the COVID and what the lockdown has meant on the economy. But we don't really know how it's going to play out, how companies are going to recover, or how resilient the economy is going to be. So what we've decided at PSG, and this is very similar to what I've said at the year-end results and again at the AGM, we're going to stick to our investment philosophy. And the first part is what we made sure is that we manage our liquidity at a group level very prudently. All term debt compromising the redeemable preference shares has been repaid. We've changed our dividend policy, and I'll get to that a little while later, where we only pay ad hoc dividends. And I can say at this stage, our liquidity position looks extremely healthy. On the underlying investment companies, and I'm very proud of every single team out there, they've done a lot of work trying to understand the effects of COVID on their business, their operations and their finances. As the case was with Kiro, we supported them in a rights issue, and numerous other companies within the group, we've done the same. And we will continue to support all these companies to make sure their balance sheets are at the strongest possible level, and we'll continue to invest in them for future growth. We will obviously look at new opportunities if it is attractive, but at this stage, given the uncertainty, it is unlikely that we will add different companies to the portfolio. The investment philosophy, I think we've talked about it a lot in the past, so I'll speak quickly about it. It's all about early stage investing. So it's got three core components to it. We've learned over the years that to build a small company takes almost as much effort as building a large company. So if you look at new markets, or new companies, it should be in markets that are large. You should not be limited by the specific niche you operate in. So banking, energy, education are examples of these large markets. Then the market should exhibit some form of characteristics, large inefficient incumbents, where you get free services like education and energy we like to play in. Historically, Capitec did brilliantly. I think if we roll back the clock 20 years ago, the four big banks at that stage were in a fairly comfortable position, and Capitec grew a phenomenal business out of the inefficiency that there were. All the markets got to be fragmented. The IFA market is a perfect example, and Consult's done brilliantly to bring a group of very good advisors into their stable. Retirement villages is one of our new industries we've gone in. It's also characterized by significant fragmentation. The last part is the management team, and this is most probably the most difficult element to get right. I wish I can say we had a silver bullet here that we can get it right every time, but only after investing you realize how good these management teams are. But by and large, when we invest in them, at the very least they need to think different, and they got to go for a different operating model than what is existing. Either a better service, lower pricing, a better experience, and even better when they can combine all three. I think that was the case that made Capitec so great. This is a little bit more expanding on our investment philosophy and how we hold. I mean, this is part of a classic economic theory. We like to invest in the startup phase or the early phases of the companies. I must say we've had investments that never truly come out of the startup phase, and we never get to make money, but that's part of the risk. Your holding period should be, if they do get the model right, and this is where we generate the high returns, because at this stage the company you've invested in beats the market. They take market share or they develop a new market. Companies cannot grow indefinitely, so at some stage growth starts slowing, and at the end of this period we'll look to exit, and maybe there are other people who can do more with it. I just want to reiterate, this was not the case with Capitec. I still believe there's significant growth left at Capitec, but as we discussed at the AGM, the financial service conglomerate regulations that came out forced us to exit the investments. We will hold on to an investment if we can generate a rebirth or a rethink in an investment, because then you go for a second phase of high growth. I just want to talk a little bit about the discounts, because we get a lot of questions about it. You can see our current discount level, or is about 43%. We've got the comparable companies, investment holding companies, as well on the graph. We obviously don't want to show who they are, but it does generate sort of an average discount, and it is significant at the moment how out of favor investment holding companies are. The average sitting on 51%, and the trend is definitely on the way down. So why are holding companies trading at such material discounts? The first part, I think, is the issue of permanent capital. Over the years and discussing it with various investors, they don't seem to like the idea that managers have the right to forever invest on their behalf. They prefer the unit trust industry where they are guaranteed, they invest at NAV, and when they want to exit, they exit at NAV. It is a main issue on investment holding companies. The fee or cost structures associated with investment holding companies is also an issue. I think especially the investment holding companies out there charging fees on their portfolio, especially if it's on NAV and not on market price, creates a significant anomaly, and I think it gives a bad rap to investment holding companies as a whole. Poor investment decisions, given that investors are locked in as a result of the permanent capital. If we as a management team don't make good decisions on behalf of shareholders, they are locked into it, and I think that creates a significant issue as well. And the last part is too many listed entry points. This is a specific problem at a PSG level. Many investors can go and generate their own portfolio or give their own weighting to the investments in the portfolio. So just on the permanent capital, and I reiterate what I started off with, our main objective is to create shareholder wealth on a per share basis. And I want to reiterate that we are not, we remain a long-term investor, but we are not a permanent investor. We will unlock value, as you can see, through the sale of Pioneer and the unbundling of Capitec. On the fee cost structures, we do not charge a fee at PSG to manage the underlying assets. We will always keep this in mind to keep costs under control. So our head office costs, which are essentially the people who manage PSG Group and the PSG Alpha portfolio, and we've annualized the cost post Capitec unbundling on the smaller sum of the parts and smaller market cap. So the cost relative to the sum of the parts on an annualized basis is 0.3%, and relative to the market capitalization, it's 0.5%. Now that is actually a low fee if you put it like that, and remember it was a tough 6 months, so we didn't generate the fee income at the holding company level that we normally do, but relative to the industry, we believe that is a fair cost to pay to manage the assets. Poor investment decisions. At this stage, I don't think that's relative to PSG. Capitec was exceptional investments, and by and large, other investments significantly outperformed the JSE. Since February 2010, so over the last 10.5 years, they've delivered a compound growth of 15% over the period. Too many listed entry points, very difficult for us at PSG to solve over the short to medium term. So we just got to roll with it at the moment. This is a very busy slide on the sum of the parts. It is available on the website, and you can spend a little bit more time on it analyzing. What you will see going forward is we've opened up the Alpha portfolio and showing the top 5 companies, and there's more information that I will show in the presentation on how we value them, and the information will also constantly be available on the website. I think if we look at the pie graph on the right, in terms of the share of assets, I think the balance is significantly better at this stage. And then back to the discount, we can see, and I think the bottom graph is almost easier to talk to. It shows how we trade a premium or a discount to the share price. The slight spike at the end of 2015 had to do when we moved into the top 40. And then subsequently we had Nene Gate and we quickly dropped out of the top 40 again. But the jaw truly started opening up, firstly with the collapse of Steinhoff at the end of 2017. And then since then, it's just opened up materially. We are not that concerned as a management team at this stage about it. We do believe we have phenomenal strategies in place. Maybe not phenomenal, but let's say good. And in time, we will endeavor to close that discount for the investor community out there. A dividend policy. This was, we first expressed this at the AGM. So just historically, we paid 100% of free cash flow as an ordinary dividend. For the past 5 years, prior to the SA Reserve Bank's guidance note, the Capitec dividend we received constituted about 60% of the average PSG group dividend we paid to shareholders. And following the Capitec unbundling, PSG shareholders would now receive the Capitec dividend directly. Given, so while we think for at least the short to medium term, we will continue to trade at a sum of the parts discount, we thought it prudent as a management team, given that the equity markets would be closed to us, that we stop paying normal dividends. And that's how we get to the new dividend policy. We're only going to pay ad hoc dividends when circumstances allow. And we've expressed that while the guidance note is in place on the banking sector, we will consider to pay an ad hoc dividend for the interim period. And that's why we decided to pay the dividend of 164 cents per share. If we then get to the underlying group companies, first I'm going to talk about Curro. For the half year, they pushed their earnings up by 9%. It's easy to talk about it now. I think Curro was set for a fantastic year, but COVID really hit them hard. You can see at 30 June, we pushed our schools up by 11 to 177, and the learners was only up by 2,500. But pre-COVID, the figure, the learner numbers was actually at close to 62,500. Now, if you think about it, the preschool sector was significantly more affected than the rest. It was very difficult to provide a service to them. So of the 2,500 learners that left the Curro group during the period, 73% of them were preschool learners. But I must congratulate the team at Curro. They did extremely well under very tough COVID condition. For many years, we'd been working on a remote and online strategy, and they could basically seamlessly implement it as COVID hit. So I do not think any learner in the Curro system ever got left behind, and we're going to continue building on it so that in the years to come we can have a hybrid system going and reduce the cost even more. Obviously sport, as with the rest of the country, was cancelled, but we did a lot of effort to provide the learners with home-based training programs. And as far as the culture is concerned, it basically continued as is, with significant online channels being used to deliver the product. So, as we stated on the interim results, the revenue was up 7%. And if you think about the increase in bad debts and the discounts of percentage relative to revenue, the fact that we delivered an increase in recurring earnings was a phenomenal achievement. As we've already talked about, the 1.5 billion will significantly bolster their balance sheet, reducing the debt and giving them a war chest to go after opportunities. Consult increased their recurring earnings by 7%. It's maybe the only one or one of very few financial companies operating in the financial space that manage an increase in earnings and also an increase in dividend paid out to shareholders. And this was on the back of a very strong performance by the wealth management. I think when you look at their results, one's obviously got to focus at this division. It constitutes 66% as a share of the earnings. So the asset under management increased by 11%. They had very strong inflows during the period of 6.3 billion. They had 4 advisors joining the firm, and the division increased its earnings by 25%. Insure, 19% as a percentage of the group's earnings. The gross written premium decreased by 2%. That's a result of giving discounts to certain of our clients. Our advisors shrunk by 1. We had a very strong underwriting margin period. It basically increased by 3%. Good performance on our shareholder investment income, and they managed to increase their recurring headline earnings by 17%. Asset management, the smallest of the divisions, had a tougher period. They were more aligned to the SA economy. They unfortunately had net outflows of 4.2 billion, but the management have stuck to their philosophy, and we believe they will come out of the cycle strong. If we get to Zeder, obviously the big driver there was the sale of Pioneer early in March, and the very big special dividend that they paid to shareholders of 2.30 rand per share, causing the sum of the parts to decrease to 3.73 rand per share. Most of the companies were seen as essential services, so they could operate during the lockdown period. So they may be not as affected as many of the other companies in the portfolio. I want to reiterate certain things on Zeder. Firstly, since I haven't had the opportunity, I'll apologize on behalf of them. There were significant technical shortcomings during their results announcement. We do not have control over that. I think this is part and parcel of COVID, that you are forced to do electronic results announcement. I personally think it's a better way to go forward, so we're going to stick to it, but every now and then there might be an electronic glitch. So firstly, I want to say Zeder shares PSG's DNA with its core objective of creating shareholder wealth. I must say they can only operate because that is their core principle, to invest in the agriculture and related sectors, and it's been very tough the last couple of years. With challenging weather conditions, 2 years ago we had this massive drought in the Western Cape where the bulk of our operations are, and the economic conditions certainly didn't help. Uncertainty continues to be created with the discussion in Parliament regarding expropriation without compensation, because clearly it curtails investment in these sectors as farmers are worried that they might lose their land. Zeder trades at a significant discount to its sum of the parts, and has done so for an extended period. The management team have obviously taken action, and they've sold Pioneer and Quantum Foods at significant premiums to assist unlocking value for shareholders. However, investors, and there's a lot of speculation, patience is required. There are no short-term solutions. As with PSG, before you can truly act, you must understand the effect of COVID has on the companies and how the economy is going to recover. You cannot make decisions blindly. You will be making poor decisions. Now I get to PSG Alpha. This is how we track it from a PSG perspective. Again, it's based on sum of the parts on a per share basis. So over the last 5.5 years, they've delivered a compounded return of 10%. It's most probably below what we would like to see from the divisions, but many of the companies are still in the early stage of the investment cycle, as I explained earlier in the presentation. Just to confirm how we get to the per share level, there is no gearing in Alpha. The management team there own a 1.9% stake, but the operational costs of Alpha is borne by PSG. So as they sell an investment, it gets taken out at NAV, and as new capital is required, we put it in at the NAV per share. So that's how we generate that. The current combined value is 3.6 billion. This is a summary page of the valuations of the company. So CANS is the largest investment. It's listed on the Botswana Stock Exchange and 4AX, and we use the share price to value the business. Evergreen is based on the net asset value. Stadio again is listed. Optimi, we use a P valuation, and Energy Partners is a EV/EBITDA multiple. The other investments have a combined value of 470 million. So CANS, it's the parent company of a collection of FMCG businesses that operate across the South African region. That management team has done brilliantly to build out this business. If you look at the next page, you can see where we operate in, and we're in all the Southern African companies. The bulk of the operations, though, at this stage are in Botswana and South Africa, and we're continuously looking to add other operators to the group. This is the valuation. At the current share price, it represents a 10.8 times historic PE. You can see that for the half year, the headline earnings decreased by 25%. The biggest reason for it was the rand weakening against the pula. It resulted in a net exchange loss of almost 43 million. That can potentially turn around in the second half, and we just got to see what the rand pula does. But they were also negatively affected by the lockdowns, especially in South Africa and Botswana, in terms of liquor and tobacco sales. They partially offset it, as most of the companies in the group have done, by cost savings and income from new initiatives. Get to Evergreen. It's an integrated developer and owner and operator of retirement lifestyle villages, and basically the idea is to create a leading retirement brand in South Africa and to give clients a superior lived experience. We operate under the Life Right basis, which essentially is an interest-free loan. It is extremely important, if you follow that strategy, that we look after the villages. I guess it gives the retirees significant comfort that in their last years they will have a fantastic experience, because this is what we sell and give us the right to sell life rights at the end of the day. So we make income in two ways. It's a developer margin. The first life right we normally sell for more than the cost, and then it's the fair value gains over time as property normally increases with inflation. The other expenses is obviously the general overhead expenses and the head office expenses that we do have, but in time the villages will make money from levy income, and they should be close to break even over time. We also have our own in-house healthcare services, and as the product develops and the villages fill up, we should be making a small margin on this as well. This is a very busy slide, but I think it details exactly how the group has expanded. So in FY18 we had 501 units. At this stage we have close to 970. I think as investors, you might be concerned about the number of units that were available for resale at the end of the financial year, which I have to remind everybody was February, and the fact that we still got a lot of unsold units. Just remember that when COVID hit, it was a full lockdown of our villages, and it made sales very difficult. The retirees coming into our villages in most instances do not buy off plan. They really want to view the place where they are going to retire, and we took a choice as a management team to first and foremost look after our current retirees. So we've stalled the sale of new units. I can confirm that after half year it's slowly starting to pick up as the COVID restricting levels come down. There is more detail on the next page on where the units are. We currently do have land to build about 5,500 units. At this stage, we have stalled the process of building new units just for the while. Again, we want to see how COVID-19 plays out. Then Stadio. Their mission statement is to build a credible private university with more than 100,000 students. At this stage they have about 32,000 students, and the product that we sell are our accredited qualifications, of which we got 97, with a further 37 in the pipeline. We operate from 14 existing sites, and the split is 80% off campus with 20% being on campus. We believe as this product goes forward, that ratio should stay approximately the same. So what are we moving towards? We're in the process of merging our 6 brands into one Stadio. They still operate as individuals. We believe there's significant benefit, especially in terms of marketing, that will come from the single brand. We are in the process of developing multi-faculty campuses in both Centurion and Durbanville. Unfortunately, with the lockdown in the construction sector, we were hoping to open up the Centurion facility at the beginning of next year. Unfortunately, the 2-3 months that we weren't allowed to build will push this project out to 2022. Just in terms of their performance, you can see they increased their earnings in the first half. It was a fantastic achievement, considering also the challenges they have. And I'm quite proud of the team. They've met every single target they set out in their pre-listing statement, and they're working to building a great business. Then we'll get to Optimi. Optimi operates essentially in 4 divisions. It's offering product to homeschool learners. In the division, we got 22,000 learners, and they are supported by 1,500 tutors. They are not part of Optimi. Then we provide product directly to schools and tertiary institutions. We got more than 1,500 schools in the group who we provide product to, and 2 tertiary institutions. In the recent years, we've added training facilities at the workplace. So we have more than 200 businesses that we do provide services, and there we have more than 100,000 learners. By and large, this is adult matric. And then we recently bought College SA, which we've rebranded to Optimi College, and this is accredited short courses where we have more than 5,300 students. The business performed extremely well in COVID, as you can expect it, given the core of the product is a digital learning format. Unfortunately, the Optimi workplace struggled because these are providing services directly to people at businesses, and given the restrictions with COVID, most of them plan to delay it to next year. So they do it by what they have trademarked, the guided learning model. It's based on integrating the 5 core elements needed for effective learning and facilitation. They constantly do research and look at what other people across the globe are doing in terms of especially online learning. They've put a massive amount of effort in their technology ecosystem, and by and large, the centralized focus and aim is to lower the cost of learning through centralization and automation. If we get to the valuation over here, and this will also be on the website, we had a more complex valuation, but we thought, given that the market out there might want to value it on its own, let's keep it simple. So we've included the recurring earnings at the bottom. We place it on a 13.3 times P, which yields a valuation of 216 for the group. I've just seen there might be a little error here on the 17 and 18 figures. Then we get to Energy Partners. It's a fully integrated private utility business. The primary focus here is to grow its investment portfolio of energy assets. It operates in 3 divisions: solar, refrigeration and steam, and then it also has energy intelligence solution divisions which provide services to our many clients. So the model basically consists about 2 parts: the operational business. They do build and steam and solar facilities and also cooling facilities for clients on cash, where we make a margin, but they also serve as the operation and maintenance division to our own investment assets. Then obviously the second part, which is our core business, is in time we want to build a utility owning our own energy assets. Now, on a valuation basis, we've gone and looked at how similar business across the globe value these businesses, and the EV/EBITDA model seems to be the best. We valued the operating business on a 6 times multiple and the investment side of the business 10 times. In the global companies that we've used as benchmarks, they don't split these 2 divisions, but the companies do trade at sort of a 20 times EV/EBITDA and 4 times price to book. So we feel quite comfortable with the metrics we've used to date. Again, over here, you can see how at the top, our investment book has grown. And then we also show the EBITDA from the operations and the investments. We do the multiplication, we deduct the debt, and then we add back the work in progress, because that really hasn't it doesn't generate earnings yet, but it does have an effect on debt, and you get to the valuation at the end of the day. At the bottom, we'll also show you the average yield on the assets, and that is highly attractive, and the yields increase over time because they mostly increase with inflation. The other investments within the group is the Stellenbosch Nanofiber company. It's still phenomenal technology. We've teamed up with Taiki, a Japanese cosmetics company, and also during COVID, we produced and developed commercial face masks. This was especially used in the medical industry. Carter, our newest investment, they're setting out to improve the new car purchase experience. They currently own the number 1 or 2 Renault dealerships in South Africa. Provest is a mining support system. It's a black-owned company. We own the other part of it. They essentially operate in the platinum sector. They were also affected as mines also closed during the height of COVID. And Spirit Capital is a LBO specialist, and they got 5 investments within the group. If you want more information on the underlying businesses, as I've stated at the outset, most of the businesses either have June or August interim results. And if you want more information on each of them, please go and have a look at the websites over here. The investor relations pages are very good. They all have presentations out there. The only one that hasn't been updated yet is Kaap Agri. They have a September year-end, so in the next month or so, their interim results, the year-end results will become available. I thank you all for listening. I'll apologize if I speak a little bit slow and without a lot of tone, and I'll go to questions now.
Thank you, Piet, for the presentation. We've received several questions and we'll go through them. Please, if you have any questions, send that to us as soon as possible to make sure that we can address it. The first question, and actually there were various questions regarding the potential amendments to Section 46 of the Income Tax Act relating to rollover relief of future unbundlings of listed shares and CGT provisions if the amendments are enacted. Now, perhaps, Piet, I can just answer that question, and that is that we've noted the potential amendments. It is important to note that it's still in a draft format. I understand that in its current form, it will or could affect future unbundlings and potentially in practice put an end to unbundlings, as most of the top 100 listed entities may have shareholders that can be regarded as disqualified parties, namely parties such as the PIC, pension funds, foreigners, etc., holding more than 20%. So our view is to wait and see what is the final regulations before we comment. Otherwise, we will only be speculating. The same goes for the second part of the question regarding CGT on our portfolio in such instance. Until the regulations are promulgated, we cannot calculate the effect. Okay, so then we move on to the other questions. The first one is, which valuation methodologies are applied to the individual alpha assets, Piet?
Thank you, Johan. I think we've addressed it quite nicely. We've tried to use share price where it is applicable. Definitely the next level is to use PEs, as we've done with Optimi, and the EV/EBITDA multiple that we apply to energy partners. As I've stated, these details will be on the website as well if you want to take your time on analyzing it. We'll also start showing more and more information as time goes along. And then the NAV basis that's based off market valuations on a per square sales methodology at Evergreen.
Okay, thank you, Piet. The next question is, well done on creating value for investors. Are there any limitations to buy back shares, and could it trigger mandatory offers and the like? Maybe I can just say there, Piet, that we have the authority to buy back up to 20%. I mean, that authority is in place and renewed usually on an annual basis at AGM. I can't see where I am now that it will trigger any mandatory offers at the moment. And whenever we cross the 3% buyback line, we would in any event be obliged to announce that to the market. So hopefully that answers that question. To go on, there's more questions from this individual. Why did the company not repurchase large amount of shares after the unbundling of Capitec? Piet?
Thank you. I think to only go after share buybacks is only one part of a strategy. We want to be there for the investee companies to help them grow their portfolio. I think you create value once off if you do share buybacks. I think in the long run, and we're not disregarding share buybacks, I'm just saying in the long run, we will create the most value for shareholders if we are able to grow their underlying businesses. And we have to be in a position and have capital available to do so going forward.
Thank you, Piet. Following on that, there's another question, and that is, why did you decide to pay an ad hoc dividend rather than buying back shares? Previously, it would be immaterial, as you've indicated before, but now it could be different.
I think I explained it quite well in the presentation, but I will reiterate. At the AGM, we did explain a change in our dividend philosophy. I think many shareholders out there are dependent on the dividend, and I think we've explained it quite nicely. Whilst the SARB guidance note is in place, we always said we would consider paying an interim dividend, and we've done so. But I think the expectation of future dividends from a PSG level should not be there. Investors should see this as an ad hoc dividend.
Okay, thank you, Piet. I may just note that some of the questions obviously came through in the beginning of the presentation, so the participants may not have listened to you at that stage. Okay, the next question is there any strategic benefit to holding the PSG Consult stake? Would Consult not also potentially benefit from a higher free float?
At this stage, I think there is still benefit for both us and Consult to have us as the key shareholder. It gives them stability, and the management can focus on driving the operation. So I think both us and the management team of Consult are very happy with the current situation. Just to get back to the question of buying back shares, we did buy back 1% of PSG shares in the period following the unbundling of Capitec. So it's not that we've done nothing.
Thank you, Piet. The next one is PSG is in a good liquidity position with no borrowings. Does it intend to remain debt-free, or when will it incur more borrowings?
One's always got to remember, if you say that question and there's different arguments how you view debt, we do have perpetual preference shares. Some parts of the community see it as an equity instrument, but truly, if you look at it from our perspective, we have to service those dividends on a biannual basis. So it is effective gearing, no matter how you look at it. So there is gearing at PSG group level.
Thank you. The next question is, Piet, you sounds there are opportunities going forward, and you sound positive about PSG group in years to come. Why are you positive?
That's an interesting question. Firstly, I don't believe it serves anybody well within the group if you are negative. I do get to spend a lot of time with phenomenal management teams. They've done extremely well under COVID. They all have growth plans along with the challenges. I've said it in the past, and I'll say it again, if we can have some support from government to get their act together and create a better environment, I do believe we got the teams available to have very good years ahead of us. I can maybe speak on behalf of yourself, Johan and Wynand, our FD. We are actually very positive and excited about the opportunities in the group going forward. Nobody says it's going to be easy at the end of the day, but at least it's a positive challenge. And we're really going to give it a go over the next couple of years. I mean, for the first part of it, as the three of us sit over here on the conversation, I mean, we've got a challenge. We've got to prove to the market that some of these smaller new investments that we've made can deliver real returns for shareholders, and not just put up graphs that are based on theory, but make real delivery at the end of the day. And I think we've fallen a little bit short over the last couple of years, but we're really going to try hard to make a success of it. So it's a challenge, and to have challenges positive, because I think we can do it.
I concur, Piet. The next question is a question statement. Please confirm the future cash flows of PSG Group given the Capitec dividend and the uncertainty at Zeder. I presume PSG Consult continues to pay dividends and is ungeared. PSG Capital has got a fee income, and then there's ad hoc dividends from PSG Alpha and Zeder. No gearing, only the pref dividends in place.
That is so. Kiro also pays a small dividend, but the person asking the question has summed up the cash flow pretty accurately. I think that's another benefit of the new accounting principles. You'll see the cash flows a lot more clearly related to the head office come through. It's still a mumble jumble a little bit, just so we sort out this transition period, but you will see it clearly coming through. And that's a big reason why we changed another reason why we changed the dividend paying policy going forward. I think until such time as Kiro becomes a material payer of dividends, I think we've got to be a lot more conservative on this side.
Thank you. There's a follow-up question from the same party. PSG's dividend cash flow will be very sensitive to Zeder's new strategy and willingness to declare dividends from capital. To me, Zeder seems lost and shareholders have been left in the dark. The resignation of the CEO suggests that Zeder may change direction and will no longer pursue the previous strategy. Do you have any thoughts on Zeder and its ability to tick the boxes as a suitable investment for PSG?
I stated it in the presentation again. I'll state it again what I said in the presentation. Zeder was a niche investment company operating in the agri and related sectors. These sectors have been tough to operate in. I do believe there are very good companies within that portfolio. I think the management there have proven, and that includes Norman, who was the previous CEO, and I wish him all the best of luck for his future ventures, that they have attempted to unlock value for shareholders over time, with the selling of both Pioneer and Quantum Foods at significant premiums to the prices they were trading at prior to the sale. We will endeavour to create as much value for shareholders over time. But I will say, and this everybody's got to take to heart, you cannot expect anything in the short term. We might have had a lot of plans pre-COVID, but they all got squashed. We've got to build again. And all large strategies one works on have materially been affected by COVID. Because if it's a big buy or a big sell or a total restructure, everybody wants to see how COVID plays out and how the country recovers. So if you are looking for a short-term arbitrage play, then I don't think Zeder is an investment for you. But I can give you the assurance that the management team, the board of Zeder are constantly thinking of plans. It is a large investment for us. We will help them with the thinking and give our own thoughts to it. But that is where it is. Unfortunately, we cannot change anything in the short term. I will reiterate that COVID makes it very difficult, and everybody out there wants to understand the effects it had on the business and how it is going to be affected going forward in a recovery scenario.
Thank you. The next question is, and I think you've already answered part of this question, but I'll read it again. Given the economic climate and the group's intention to manage liquidity carefully, would you say it is unlikely that PSG will repurchase more shares in the short to medium term?
Again, as I've stated before, we've got to balance our liquidity needs with the plans. We've got to grow the underlying investee portfolio, but we will always explore it as part of a value creation strategy to repurchase shares if it is opportune for PSG and we can create value for shareholders.
Thank you. I think there's a number of questions around that, so I think we have answered that to a degree. So I'm not going to, for those participants, I think we have answered. If a new angle comes out, we will address that. The next question is, why did you keep part of the stake in Capitec?
We've explained it quite well with the unbundling announcement, and it really has to do with the liquidity position at PSG. As I've stated, and a big part of my presentation dealt with the discount at which investment holding companies trade at. We would post Capitec unbundling, we don't get the dividend flow anymore, and we would be unlikely to be able to tap the equity markets for additional capital. So for prudency's sakes, we retain some Capitec shares to give us a war chest going forward.
Thank you, Piet. Okay, the next question is, you previously mentioned that you would relook at whether it makes sense to have some of the smaller entities listed if markets are not conducive for funding their growth. Is this still the case, and could you look to delist some?
Firstly, I just want to explain the terminology delist, because I get that question a lot. That's not really an option to delist the company. The only option available is to take out the minorities at a premium. My understanding is, and maybe Johan, you can elaborate, that the premiums you have to pay in COVID might be significant due to shareholders' differing viewpoint on the valuation of a company. I don't think it is necessary at this stage to go and pay 40-50% premiums to take out the minorities to be able to delist the company at this stage. So we will always explore it, think about it. If there is an opportunity, we will act in that regard.
Thank you, Piet. Maybe I can just add, from a listing perspective, to list the smaller entities in these markets is going to be very difficult. So I don't foresee this on the short to medium term as we sit here. And then yes, usually premiums are around 30%, but it depends on the company and the circumstances. Just want to, if you can give me another sort of 30 seconds to a minute. I just want to see if all the questions have come through. It looks like this is the last question. Maybe there's still one more. Please, can you take us through the possible use of proceeds, given that you are changing the dividend policy? I think you've answered that in part, meaning what will you do with the excess cash that you've got available?
To that shareholder, I can only say time will tell. We've obviously got a lot of plans here at PSG Group, and without giving away all our strategies. This is essentially available to support the growth of the underlying portfolio.
Thank you, Piet. The last question, I think, unless something comes through now while we're talking, under what condition will PSG consider selling its remaining Capitec shares?
Again, there is a strategy that sits with the executive committee at PSG. I mean, obviously, if somebody came and offered us 1,500 rand per share, I'm pretty much sure we'll sell it tomorrow.
Yeah, I agree. It depends on the opportunities, Piet, that's available and the market. So I'm going to give it still another 10 or 20 seconds to see if there isn't a further question.
But maybe, Johan, just while we're at it and discussing, I've spoken about this in the past, and it really is regarding listings in general. And I think the JSE should take note, and hopefully they also sometimes listen in on these conversations. The red tape is becoming excessive in the listed environment, and I do think it makes it inherently unfair, the operating environment between listed companies and unlisted companies. I hope they take note, because obviously it's good for the economy if there's a lot of listed companies out there, but in time we might see further delistings or taking out of minorities, as I put it, because the red tape.
Yeah, that is a problem of the times we live in. There's a lot of corporate failures, and then you have to regulate, but when do you go too far? When you don't, you go too far. So it's always a balance. We don't have any further questions, so therefore we are going to conclude the session. Thank you very much for participating. We appreciate it.